What if I told you that the world's largest silver ETF, trusted by millions of investors with $14 billion in assets, might not have a single ounce of actual silver backing your shares? I'm not talking about a small discrepancy. I'm talking about the possibility that SLV, the iShares Silver Trust, is the biggest paper illusion in financial history. Yesterday, I obtained a copy of the full SLV prospectus, all 67 pages. And what I found buried in the legal language is so disturbing that I had to triple check before making this video. Let me read you the exact quote from page 11. The trust's silver may be held by one or more subcustodians, and the custodian may not require the subcustodians to comply with the same requirements regarding the safekeeping of silver that the custodian itself is required to comply with. Let me translate that into plain English. The silver that's supposed to back your SLV shares can be held by unknown third parties, and those third parties don't have to follow the same security rules as the main custodian. Your silver investment could be sitting in a warehouse you've never heard of, managed by people with no accountability to you, under rules that the prospectus admits might not even protect the metal. And here's what should terrify every SLV shareholder. The same institution that serves as SLV's custodian, JP Morgan, paid $920 million in 2020 for manipulating the precious metals market. I'm John A.G., and what I'm about to show you could be the biggest financial scandal since 2008. Stay with me. But the subcustodian issue is only the beginning. Later in this video, I'm going to show you the 6 words buried in the prospectus that allow SLV to operate without ever proving it has physical silver. 6 words that create a legal loophole big enough to drive a truck through. I'm also going to reveal what happens to your shares if the silver doesn't exist. Spoiler, you don't get silver. You don't even get full cash value. You get whatever's left after creditors are paid. When you see the full picture of how SLV is structured, you'll understand why some of the smartest money managers in the world refuse to touch it. Let me explain how silver ETFs are supposed to work, because understanding the structure is critical to seeing the problem. An ETF, or exchange-traded fund, is supposed to give you exposure to an asset without directly owning it. In the case of SLV, each share is supposed to represent approximately 0.92 ounces of physical silver held in vaults. When you buy SLV, your money goes to the fund. The fund is supposed to buy physical silver, and that silver is supposed to be stored securely by a custodian. In theory, if SLV has $14 billion in assets and silver is trading at $77 per ounce, there should be approximately 182 million ounces of physical silver sitting in vaults backing those shares. 182 million ounces. That's more than twice the entire registered inventory of COMEX. It would make SLV one of the largest silver holders in the world. But here's the critical question. Where is the silver? Who has verified it exists? And what happens if it's not there? These aren't hypothetical concerns. They're questions that the prospectus itself raises, if you read it carefully. The structure of SLV creates multiple layers of risk that most investors never consider. Counterparty risk, custodial risk, subcustodial risk, and what I call existence risk. The risk that the silver simply isn't there. And the prospectus, the legal document you agreed to when buying shares, provides far less protection than most investors realize. Welcome to Macro Shield Method. I'm John A.G. If you're new here, hit subscribe and drop a like. This is the analysis that could save you from a $14 billion house of cards. Help me spread it. Now let me show you exactly what the prospectus says. I'm going to read directly from the SLV prospectus. Every quote I share is publicly available. You can verify this yourself. Let's start with the subcustodian language I mentioned earlier. Page 11. The custodian may appoint subcustodians to hold the trust's silver. Neither the trustee nor the custodian monitors the performance of subcustodians or has the ability to compel subcustodians to take any particular action. Neither monitors nor compels. The entities holding your silver have no oversight from anyone accountable to you. It gets worse. Page 12. The ability of the trustee to monitor the performance of the custodian may be limited because, under the custody agreement, the trustee has only limited rights to visit the premises of the custodian. Limited rights to visit. The trustee, who's supposed to protect shareholders, has restricted access to even see where the silver is supposedly stored. But here are the 6 words I mentioned. Page 15. Silver held in an unallocated account. Let me explain what unallocated means, because this is where the entire structure falls apart. Allocated silver means specific bars with specific serial numbers assigned to your account. If the custodian goes bankrupt, those bars are yours. They're identified, segregated, and protected. Unallocated silver means you have a claim against the custodian for a quantity of silver. You don't own specific bars. You own a promise. And if the custodian goes bankrupt, you're an unsecured creditor. The prospectus explicitly allows SLV's silver to be held in unallocated accounts. Your silver could be nothing more than an entry on J.P. Morgan's books. Now here's the audit situation. Page 23. The custodian will provide a written certification of the total amount of silver held by it on behalf of the trust. This certification will be provided twice per year. Twice per year. For a $14 billion fund holding supposedly 182 million ounces of silver, the verification is 2 written certifications annually, provided by the same custodian holding the silver. J.P. Morgan certifies that J.P. Morgan is holding the silver properly. What could possibly go wrong? There's no independent, continuous verification. There's no requirement for physical bar counts by third parties. There's no real-time accountability for 182 million ounces of supposedly physical metal. And here's the most damning section. Page 27, regarding what happens if the trust terminates. If the trust is terminated, the trustee will sell the silver held by the trust and distribute the cash proceeds to the shareholders. Sell the silver, distribute cash proceeds. If SLV liquidates, you don't get silver, you get cash. And if the silver doesn't exist, if the subcustodians can't produce the metal, then you get whatever cash can be recovered after legal proceedings. The prospectus essentially admits that SLV shareholders have no direct claim to physical silver. You have a claim to the cash value of what should exist. Do you see the difference? Physical silver holders own metal. SLV shareholders own a claim on a trust that holds claims on custodians that may hold claims on subcustodians that might have silver somewhere. Every layer adds counterparty risk, and the prospectus provides legal cover for every layer to fail. Now let me show you what's happening in the physical market that makes the SLV structure even more concerning. COMEX registered silver currently stands at 85 million ounces. That's all the silver available for delivery on the world's primary futures exchange. SLV claims to hold 182 million ounces, more than double COMEX registered inventory. If SLV's silver actually exists, it would represent approximately 22% of identifiable global above-ground silver inventory. One single ETF supposedly controlling nearly a quarter of all available investment silver. But here's what doesn't add up. When silver experiences massive buying pressure, when delivery rates spike, when the physical market shows stress, SLV's reported holdings remain remarkably stable. In February, when COMEX delivery rates hit 97% and physical premiums exploded to $85 over spot, SLV's silver holdings barely moved. The physical market was screaming shortage. SLV's silver sat perfectly still. During the January crash from $121 to $64, a 47% collapse that should have triggered massive SLV redemptions, the trust's silver holdings decreased by less than 3%. The physical market shows violent dislocations. SLV shows eerie stability. Either SLV is the most stable silver holding in history, or the numbers don't reflect reality. And consider the authorized participant structure. Authorized participants are the large financial institutions that can create and redeem SLV shares. They're supposed to deliver silver to the trust when creating shares and receive silver when redeeming. But here's what the prospectus allows. Page 19. Authorized participants may deliver silver to and receive silver from the custodian in unallocated form. Unallocated form. The authorized participants creating and redeeming shares don't have to deliver or receive specific allocated silver. They can transfer book entries. This creates a system where silver moves between accounts without physical metal ever changing hands. It's a paper shuffle that maintains the appearance of silver backing without requiring actual metal movement. Some analysts call this fractional reserve silver. The trust holds some physical metal and relies on book entries and claims for the rest. It's the same structure that allowed the gold market to operate with paper claims vastly exceeding physical supply for decades. And it works until someone demands delivery and the metal isn't there. The recent physical market stress, the COMEX inventory decline, the delivery rate spikes, the dealer shortages, these are all signs that claims are exceeding metal. What happens to SLV when the music stops? Now I need to explain who benefits from this structure and why it's been allowed to continue. J.P. Morgan serves as SLV's custodian. This is the same J.P. Morgan that paid $920 million in 2020 to settle charges of manipulating precious metals markets through spoofing and layering trades, holds one of the largest precious metals trading operations in the world. According to CFTC data, maintains significant short positions in silver futures, and now serves as custodian for the world's largest silver ETF. Think about that structure for a moment. The institution with the largest trading operation and significant short positions is responsible for safeguarding the silver that's supposed to back the world's largest silver investment vehicle. That's like letting the fox guard the hen house while also running a chicken restaurant. And look at the incentives. If SLV's structure allows unallocated holding, if silver can exist as book entries rather than physical bars, then J.P. Morgan can potentially use that silver for their trading operations. Silver can be leased, it can be pledged, It can serve as collateral. And as long as nobody demands physical delivery en masse, the system continues. But the recent market stress suggests the system is cracking. London lease rates spiked to 12% last month. That's the cost of borrowing physical silver temporarily. Normal rates are under 1%. When lease rates spike, it means institutions are desperate for physical metal. If SLV silver were readily available, sitting safely in vaults, why would lease rates spike? Someone with 182 million ounces could easily satisfy borrowing demand, unless the silver isn't as available as the book suggests. And here's what concerns me most. The prospectus explicitly protects JP Morgan from liability for subcustodian failures. Page 13. The custodian is not responsible for the acts or omissions of any subcustodian. If a subcustodian loses silver, if metal disappears from a vault somewhere in the subcustodian chain, JP Morgan isn't liable. The trust eats the loss, shareholders bear the risk. You're trusting your silver investment to a chain of entities where each link is protected from liability for the next link's failures. This isn't a silver investment, it's a game of hot potato where you're always holding the risk. Now I need to be balanced here, because that's what we do on this channel. I'm not claiming that SLV has zero silver. The title of this video uses zero provocatively to highlight the structural concerns. Let me be precise about what I am and am not saying. And what I am saying, the prospectus allows for structures that could result in SLV having less physical silver than claimed, through unallocated holding subcustodian arrangements and limited verification. What I am not saying, that I have proof SLV has no silver. I don't have access to their vaults. I cannot independently verify their holdings. The prospectus language creates legal cover for scenarios ranging from 100% physical silver fully allocated to significant portion held as unallocated claims. SLV could be completely legitimate, with 182 million ounces sitting in secure vaults with proper controls. The prospectus disclosures could be conservative legal language that doesn't reflect actual practice. That's possible. But here's my concern. When the physical market shows severe stress, when premiums explode, when delivery rates hit 97%, when dealers ration inventory, and SLV's holdings remain perfectly stable, that divergence needs explanation. Either SLV operates in a completely separate market from physical silver, or the numbers deserve scrutiny. I'm raising questions the prospectus itself raises. I'm highlighting risks the legal documents disclose. I'm not making accusations beyond what the fund's own filings suggest is possible. Every SLV shareholder should read the prospectus. Every investor should understand the subcustodian structure. And everyone should make their own determination about whether the risks justify the convenience. Let me explain what happens in the worst-case scenario for SLV holders. A major authorized participant demands physical redemption. A large redemption, say 10 million ounces. The custodian goes to retrieve the silver, but the silver is held by subcustodians, and the subcustodians don't have allocated bars. They have unallocated claims on other entities. The redemption can't be fulfilled in physical form. The trust invokes force majeure provisions. Cash settlement is offered instead. Simultaneously, news leaks that SLV couldn't satisfy a physical redemption. Other authorized participants rush to redeem before the silver runs out. A bank run on an ETF. The trust suspends redemptions, citing market conditions. Shares continue trading, but at a massive discount to NAV, because redemption arbitrage is broken. Eventually, the trust liquidates. Lawyers get involved. Years of litigation follow. Shareholders receive cents on the dollar years later. This isn't fantasy. This is what the prospectus allows. Every risk I just described is disclosed as possible. And consider the systemic implications. SLV holds $14 billion in assets. If SLV's structure fails, confidence in precious metals ETFs collapses entirely. GLD, SIVR, PSLV, every ETF faces redemption pressure. Simultaneously, investors who thought they owned silver through SLV rush to acquire physical metal. Physical demand spikes at the exact moment the paper structure is failing. The already stressed physical market breaks. Premiums go to 100%, 200% more. Spot price and physical price completely diverge. The paper market becomes irrelevant. This isn't a silver-specific crisis. It's a financial system crisis when investors realize that paper claims vastly exceed physical assets across multiple markets. Am I predicting this happens tomorrow? No, but the structure allows it. And the physical market stress suggests we're closer to that scenario than at any point in decades. There's direct historical precedent for paper claims exceeding physical assets. In 2022, the London Metal Exchange nickel market collapsed when it became clear that physical nickel inventory had been sold multiple times over through paper claims. Nickel prices quadrupled in 48 hours. The exchange halted trading. They canceled 2 days of trades, erasing billions in legitimate profits. Investors who were right about nickel still lost because the system couldn't function. The structure that allowed that failure, paper claims, Exceeding physical metal is the same structure underlying SLV. Different metal, same architecture. In the 1970s, the Hunt brothers attempted to corner the silver market. They discovered that paper silver claims vastly exceeded physical supply. The exchanges changed rules mid-game to stop them, but the imbalance they exposed was real. More recently, consider the 2020 oil market where futures prices went negative because paper claims met physical reality. Storage was full. Paper contracts couldn't find physical barrels. The price went below zero. Every time paper markets meet physical constraints, the adjustment is violent. Paper prices that seemed stable for years suddenly reprice in hours or days. SLV represents $14 billion of paper claims on what should be 182 million ounces of physical silver. When that paper meets physical reality, what happens to the price of your shares? The prospectus doesn't protect you. It protects the custodian. It protects the trustee. It protects the authorized participants. The only party without explicit protection is you, the shareholder. Here's what I think is happening. SLV was created in an era when physical silver was readily available. The structure made sense when subcustodians had ample metal, when unallocated holding was a convenience rather than a risk. But the physical market has fundamentally changed. Supply deficits for 6 consecutive years, industrial demand at record highs, government now designating silver as strategic and stockpiling, COMEX inventory cut in half, Shanghai inventory down 36%, dealer rationing emerging. The comfortable assumptions underlying SLV's structure no longer hold. The physical market is stressed. Claims may exceed metal, and the prospectus provides legal cover for exactly this scenario. The language about subcustodians, unallocated accounts, limited verification, it's all there because someone anticipated that physical backing might become an issue. Wall Street isn't stupid. They wrote a prospectus that protects them when things go wrong. The question is whether shareholders understood what they agreed to. I believe the physical silver market is repricing. Physical metal is becoming more valuable relative to paper claims. The premiums at dealers, the delivery rates at COMEX, the inventory declines, all point to physical scarcity. When physical reprices high enough relative to paper, structures like SLV face stress. The arbitrage that keeps ETFs trading near NAV requires physical availability. When physical isn't available, the structure breaks. The question isn't whether you should own silver. The question is whether you own actual silver or a claim on a claim on a claim that might reference silver somewhere. For me, the answer is clear. Physical metal in your possession has no counterparty risk. SLV has multiple layers of counterparty risk, all disclosed in a prospectus most shareholders never read. This is my analysis, not financial advice. Do your own research, make your own decisions. Read the SLV prospectus yourself. It's available free online. Every concerning quote I shared is in that document. Verify it. Think about what it means. $14 billion in assets, 182 million claimed ounces, subcustodians without oversight, unallocated accounts permitted, twice yearly self-certification, no independent verification, limited liability for custodians, shareholders as unsecured creditors in liquidation. This is the structure you're trusting with your silver investment. Maybe it works perfectly. Maybe all 182 million ounces are sitting safely in vaults with proper controls. Maybe my concerns are overblown. Or maybe the prospectus language exists because the structure has vulnerabilities that shareholders should understand before investing. Drop a comment below. Do you hold SLV? Are you reconsidering after seeing the prospectus language? Have you moved from paper silver to physical? I want to hear your perspective. I'll pin the best responses. Share this video with everyone who owns SLV. Most shareholders have never read the prospectus. They don't know about subcustodians. They don't understand unallocated accounts. They deserve to know what they actually own. If you're not subscribed, hit that button now. I'm covering the paper versus physical disconnect daily as this situation evolves. The prospectus is just the beginning. Wait until you see the COMEX warehouse data I'm analyzing next. I'm John A.G. This is Macro Shield Method. Protect your wealth, understand the system,